Welcome to Zoom at 8. My name is Julianne Peterson, and I am your host of Zoom at 8 every Tuesday night. I'm so glad you're here, as many of you have been here for the last 3.5 years. Kenneth has been here for 3.5 years. Mark has been here for 3.5 years. And so I thank you for your support. We have been wildly successful to many, many folks. Whether you have been in this for years and years and years, or you're brand new, Zoom at 8 can be something special for you. You know, I bring lots of different folks here as speakers. Also, we bring, guests here that can provide you with, maybe insurance brokers, attorneys, or maybe even just somebody that has $50,000 that's looking to place capital into maybe your deal. So Zoom at 8 has been a great resource for so many people, and hopefully we can help connect you. I am a loan officer for Old Capital Lending. We've been in business for 35, 36 years. And 2022 was a struggle for many, many companies. We still came through with $1.2 billion in loans. So we had a great year. And I don't know, we're looking forward to another actually interesting 2023. Freddie Small Balance just dropped their prices 35 basis points. So interesting. I think the Fed is still going to be raising 1 or 2 more times in the near future. So your bridge loans, if you're in a bridge loan, you might have some more increases, which is going to maybe hurt your cash flow. I think the forward curve is looking like maybe in the third quarter, we're going to see some downturn on that interest rate, but who knows, right? My crystal ball is from Walmart. It's a piece of junk, so don't, get some information from a lot of sources. All right. So tonight we've got Jason Mezyk, and we're going to learn about risk release. If any of you have insurance with your residents, maybe you don't. Tonight, you're going to learn about that. Let's get on with the show. Tonight, everybody, I want you to meet somebody who came into my space just right before the beginning of the year. Jason Mezyk came, I met him at one of our conferences in Dallas, and amazing how he knows people I know. He lives where I lived. And so I thought, hey, he's doing something that everybody should know about. And what a great way to get him on Zoom at 8. So Jason Mezyk is here tonight. He is the Chief Executive Officer of RiskRelease. He brings 20 years of real estate and risk management experience to his team. Prior to his relocation to Dallas, he held a global role in risk management for Blackstone's real estate portfolio companies. He led the creation of Blackstone's first ever captive insurance program and structured various alternative risk instruments such as parametric and CAT bond solutions. Jason received his degree in finance from the University of Illinois in Champaign-Urbana, and has an MBA from DePaul Graduate School of Business in Chicago. He holds an associate in risk management designation and is the past president of the Chicago RIMS chapter. And in his free time, Jason enjoys investing in real estate, which is awesome, golfing, fishing, and spending time with his wife and 3 children. So I am so excited to hear more about this. If everybody would take the moment and go to the right-hand side of your screen and make it speaker view so we can get to know Jason on a one-on-one basis. Jason, good evening. Thank you so much for taking time out of your night to spend with us here at Zoom at 8. How are you?
I'm good, Julie, and appreciate the opportunity to speak to this group. When Julie and I first met and she talked about the opportunity to come on and speak, I said, well, first, I'm flattered because obviously, she's done some tremendous things with her career in Old Capital. But I said before I speak, I want to sit in on a few of these just to kind of get a feel for who's attending, what people are talking about. And I have been overwhelmed and just super impressed by all of the different people and the stories and the successes and the collaboration. And so I hope that tonight I'll be able to bring some insights around risk and insurance. And while I've done a lot of really neat things in that space, when I hear stories about Kenneth putting personal guarantees on deals and getting them done at the very last hour, and Elena, putting equity in as an LP on 15 deals and saying, okay, we're going to get into the GP space. And, next thing you know, you're in another 5, 7, 8 deals. I mean, it's just tremendous, the work ethic, the discipline. So really, really, really cool, and happy to be here. So I am going to tell you a little bit about RiskRelease and the company that I'm helping lead here in Dallas. But before I do that, I wanted to spend a little bit of time just talking about the property and casualty insurance market, and certainly would like to keep it free form and allow folks to put questions in the chat or just come off of mute and say, Jason, can you tell me a little bit more about this? Because I can say that when I hear about bridge loans and personal guarantees and, there's just a lot of stuff that I'd like to learn more about. And so hopefully this won't be my last Zoom at 8, but I did put a couple slides together. It's not super duper impressive, but I will share a screen just so that there's a little bit of visual to go along here. And as I said, feel free to, stop me or raise your hand in the chat, and I'll try and answer those questions.
And just to get clarity, I want to make sure that everybody understands this is not for the property itself. This is for your residents, correct? RiskRelease
as a solution, yes, well, it's both, right? And so we'll talk a little bit about that, but I think it's important to just talk a little bit about why RiskRelease was born and kind of how it serves to solve a problem that exists across all multifamily communities all across the country. And so when you're a GP or an LP on a deal and you're looking at an opportunity, right? You're going to look at the investment offering. You're going to see what kind of underwriting assumptions they made. And rent growth is something that I always look at when I look at a deal. The loan terms is another thing that I look at when I look at a deal. But, the insurance expense line item is something that a lot of people probably often overlook, and what kind of assumptions are being made there. And what I would tell you is, depending on where you are geographically, other than taxes and obviously your debt burden, the insurance expense line item is a significant contributor to the overall operating performance of the asset. And geographically, depending on where you sit, the actual insurance costs and the fluctuation of those costs year over year can be vastly different. And so, the first slide that I just kind of wanted to point to is a lot of times people talk about changes in insurance costs, year over year. But when you live and breathe in a risk management space, you actually look at it and you're actually talking about it on a quarter over quarter basis. And the reason that you do that is because you have a significant hailstorm in Dallas, or you have a tornado that rips through Kansas City, or you have these heavy storms and the flooding out in California, or you get a year like 2017 where you have Hurricane Harvey, Irma, and Maria all coming through, within weeks of each other. And these types of events have the ability to swing insurance costs into, the double digits, literally in a period of months. And the reason that happens is because insurance underwriters are constantly evaluating the book of business that they write premiums for. And if it's looking like their underwriting is going to basically fall through the floor and bottom out, the only way that they're going to be willing to write more premium in any given year is if they write it at a higher rate. In fact, their supervisors or whoever they have to report up to won't even let them quote insurance. And so I'm not an insurance broker, and certainly I'm sure Julie can recommend a number of folks that can provide those kind of services. But I show this slide only because it literally shows, when people talk about inflation numbers, right? Month over month, plus 8%, plus 9%. We're literally looking at, 8 to 15 to 20% increases just moving from one quarter to the next year over year. So it's definitely something to be mindful of. And so I talked a little bit about events that kind of drive this kind of stuff. But when you think about climate change and global warming and severe weather patterns, I think the data doesn't lie, right? And so this is basically a graphic that got put out by NOAA, and you can see that in 2021 there were 20 different events that caused in excess of $1 billion in damage. And so as you think about where am I interested in investing and where do I have an appetite, I mean, I think your eyes are going to naturally be attracted to the coasts, right? Anything that's in hurricane alley or has hurricane exposure is going to have some significant premium implications. And then it's always been wildfires, but now this year with the recent storms in California, it's going to be flooding. And so it can be very, very difficult to underwrite and predict what your insurance costs are going to be in these areas. And so you look at it and you're like, gosh, 2021, man, that was an incredibly terrible year as far as, events. But here you look to last year and they had 18 separate $1 billion weather events. And so, back-to-back years, and I'm sure if, depending on where you live, you can look at some of these events. And this one actually doesn't even incorporate the winter freeze that happened in and around Texas, right around Christmas time, right? So as a risk manager, especially for Blackstone, they have assets all over the country, right? I mean, there isn't a market that they don't invest in. So I would find myself traveling to Florida, to walk properties after hurricane events, or walking on industrial roofs in Dallas after a hailstorm because you've got hail damage. And then obviously, some of the other stuff that you see here, maybe we were impacted, maybe we weren't. But when we would have situations like this, we would try to proactively, take steps to provide mitigation against these types of events. So one thing that people do in, particularly in Texas, is they'll install hail guards on their HVAC units, right? So you might have a building that's got, 6, 8, 10, 15 HVAC units, and they're basically just the fan coils are all exposed to the elements, right? If you have a hail event where that hail is coming in at a 45-degree angle, it can literally just destroy all the air conditioning units on a building. And that can be a pretty significant capital expense that you haven't budgeted for. And so a lot of the insurance companies now are pushing the owners and the operators to take on larger deductibles or larger retentions. And what that does is that exposes the balance sheet of the asset because they might have to stroke a really big check if they have a significant weather event or there's some sort of a fire or a flood inside the units that takes a couple of units offline. And so just kind of highlighting some of the things that I would have to deal with and that we would have to work through on a daily basis. So this is another, just a chart that kind of shows the most significant years of disaster events. And if you look at the kind of the key or the legend across the top, you can see that all these events, really the worst years on record were within the last 20 years. And so this is all playing a significant role in driving insurance costs, which obviously is something that everybody that's on this call is kind of mindful of. So another thing that I just kind of wanted to share, because I think it's an interesting fact around how large institutional owners buy insurance. Many of you, may have one or two deals. Kenneth talked about the one in San Antonio, and then, his first deal being 176 units. In those instances, when you're only trying to insure one building, you may be able to go to a single insurance carrier, right? Maybe we'll just use State Farm as an example. State Farm might be willing to write a policy for upwards of, $10 million or $5 million, depending on how large that building is. They're going to have an assigned or agreed value that they assign to that building. But when you get to a point where you have hundreds of locations, and it could even be a schedule of 10 or 12 locations, right? But if the spread of risk is such that you've got a property in Florida, a property in Texas, and a property in Arizona, if each of those is $100 million, you don't have to go buy 3 separate policies at $100 million each. You can actually buy a single policy for $100 million in limits, and it spreads across all 3 of those properties. And so where I worked in the various, kind of organizations that I was a part of, we would buy what's called shared and layered limits. And so what this is this an example of a $750 million insurance program? And that $750 million of limits that we would buy would support a $4 billion real estate portfolio. And so in order to get $750 million in limits, no one insurance company wants to basically go on the line to say, we're going to cover all that exposure. Like they basically just don't have the appetite for it. And they don't want to have, kind of the law of large numbers. They'd rather have a piece of the risk rather than take the whole thing. And so what this chart represents is our efforts to go out and secure a full 750 million in limits. And so what you can see here is, you hear about Lloyd's of London. There's a whole insurance marketplace of carriers that all kind of come to the table and say, we'll provide capacity to cover, these industrial warehouses or these apartment complexes or these hotels. But then you've also got kind of your retail or your domestic markets. And then you have these, what's called E&S or excess and surplus lines markets. And so it gets tremendously complicated. And just like somebody wants to put together a pitch book or a PPM and, their underwriting assumptions to raise capital, as a risk manager or an insurance department, we too have to put together a storybook or kind of a pitch deck, because we're going to go and present to 40 or 50 different insurance companies or underwriters and tell the story of why our portfolio is better than, if you're Blackstone, maybe you're competing with Starwood Capital or BlackRock. Or if you're First Industrial Realty Trust, maybe you're competing with Prologis or Stag or Duke Realty. And so these are kind of the ways that you want to think about, if you're going and trying to secure insurance for your own portfolio, how can you tell a story that makes your asset shine? Or how can you pitch, your portfolio of assets? Maybe you're trying to get your insurance company to take 2 or 3 different properties. What types of risk mitigation features are you doing? Whether it's security cameras, whether it's additional lighting, whether it's replacing, fuse boxes and electrical switches. There's a lot of different things that you can do that will basically improve the profile of that particular risk as you're going into your renewal cycles each and every year. So this is just a little bit about kind of property insurance at large. And now I'll kind of take a moment to transition into, who is RiskRelease? What do we do? And why does it matter for, the group that's on the call today? So one of the things that we were doing at Blackstone, and that's become more and more common, is requiring all of the residents to purchase renters legal liability insurance, right? So if you own the building and if you have a loan, whoever your lender is, they're going to require you to buy property insurance for that building, and they're going to require you to buy liability insurance for that building. And when you buy the property insurance for that building, you're going to have a deductible. Now, more often than not, those deductibles are becoming larger and larger. You might have a $25,000 deductible. You might have a $50,000 deductible. I talked with a group today that has a $150,000 deductible. So what that means is the insurance company is going to come in and they're going to pay for a loss, but you're going to be on the hook for the first $50,000 bucks. So you're going to be on the hook for the first $100,000, and you need to have reserves for that, because if you don't, you're going to have a hard time getting that unit or that building back to its original condition. So by requiring your renters to have renters legal liability, if they start a fire or if they cause a flood because they weren't paying attention, they put too much clothing in the laundry machine and it ran and it soaked everything, and maybe they were out running errands or grabbing coffee when it happened, or if they're cooking and there's a grease fire, or we've had pizza boxes catch on fire. I mean, residents do all kinds of silly things, right? And so the thought process is if they do that, the owners or the community managers have recourse against the residents. Well, that's all fine and dandy as long as the residents are actually buying that insurance. But if you or your property managers aren't doing a very diligent job of following up with each and every one of those residents and making sure that they make every monthly payment or every quarterly payment, or making sure that those residents don't come in at lease signing or when they go to get the keys and they say, here's my evidence of insurance. You give them the keys, they walk in and they call their agent a day or two later and they say, hey, go ahead and cancel that policy. I don't want to pay for it anymore. I mean, I can't tell you how many times, we encounter situations where the owners or the managers think that they've got a real good handle on this, but they don't. In fact, we find that generally somewhere between 60 and 70% of residents in Class B and Class C communities don't maintain their required renter's legal liability. So I talk to a lot of different people all over the country about this, and it just blows my mind. In fact, on Monday, I talked to a group that has 40,000 units, and they said, we require renters' legal liability, but we don't really collect it or manage it at all. So, herein lies the problem, and this is where RiskRelease, comes in and can be a solution. So what we do is we have basically what we call an insurance waiver program, whereby we will come in and we will provide insurance compliance services for the owners, for the community management companies. And in doing so, if you have a resident that fails to maintain the coverage, or they just plain old want to kind of press the easy button, we will integrate into the property management software system, be it Yardi, Resman, Entrata, Rent Manager, whereby we can actually API into the software and apply a small monthly charge as an additional fee or an additional rent on top of the monthly rent. And then we'll step in the shoes of that renter's legal liability and provide $100,000 of protection for the landlord's property, right? So that $100,000 of protection is solely for the building itself in the event that the resident causes damage due to their negligence. And it's kind of a win-win-win, because not only do we, typically that charge is about $15 a month per resident, but we typically include a revenue share of $4 or $5 a unit for the owner or for the community manager, and then RiskRelease will retain the other $10. So if you think $15, $5 going to the owner, $10 coming to RiskRelease, we use that $10 to cover our operating expenses, our developers, our application, and then we're receiving hundreds of pieces of mail each and every day that ultimately are the insurance policies for your residents. We're opening those with an envelope cutter, we're scanning everything in, we're reviewing it, we're tying it back to the particular resident at that particular unit, monitoring their lease start and end date, monitoring their policy start and end date, and we're providing all that service on the back end. And as I said, each and every month, any number of residents that are not adhering to their required renter's legal liability will provide that solution. So good for the owners because extra protection for the asset, extra revenue share for them. Good for the operators because they no longer have this ankle biting task of following up with each and every resident saying, hey, Susie, did you renew your insurance because I noticed it expired on January 1st? Or, hey, I got a certificate that said you didn't pay your premium. Did you pay it? It's not the highest and best use of their time, right? So we take that responsibility from them. We can kind of handle it from our back office with our compliance coordinators, and we take that off their plate. And then on the resident side, I like to call it the easy button because it literally is that easy. It's embedded into their lease and it's embedded into their rent. And so they don't have to go and call an agent, and they don't have to deal with an agent who's trying to sell them life insurance, trying to sell them, auto insurance, trying to sell them valuable articles insurance. Now, if you're going out and you're buying a Class A luxury mint tower at $100 million plus, right? Those are the kind of residents that might actually have some very expensive stuff inside their units. But if we're talking about workforce housing, right, B and C type units, a lot of these residents, they probably don't necessarily even understand insurance, let alone want to go through the trouble of going out and finding it. So to be able to provide this solution for them and have it be turnkey where everybody's approved, they don't have to fill out any kind of application or anything. It's really very easy for the residents, and there's no deductible or claim fees or anything like that. So if something happens, really, we just rely on the property manager to come to us and say, hey, this is what happened. This is what the resident told us. Here's a couple pictures. And then RiskRelease will say, go get 2 bids from any contractor of your choosing, choose the least expensive of the 2, make the repairs, and then have the thing, we'll send you a check and we're on our way. So it's much more expeditious than working with a farmer's or a state farm policy, because they're going to send out an insurance adjuster. You have to wait for them to come out, and then you're going to have to haggle with them over, what the cost to repair this should actually be versus what the cost is from the bid that you actually received. And then while you're negotiating all that back and forth, their policy is actually not going to pay full replacement costs. So the provisions on those renters policies are actual cash value, which means they're going to depreciate things like, the paint and the drywall and whatever it is, that everything that it costs, they're only going to want to pay you about 75% of what that is. So this is just another example of where, having the ability to provide a bid or an invoice that corresponds to the bid and having us issue a check for the exact amount, it allows you to get the building back online much more quickly. And it also allows you to not take that hit on the balance sheet of the asset, because you're not having to come up with what would otherwise be your deductible. So that's kind of, owner, operator, and resident. It works well for everybody. So what I did here is I just kind of showed you a screenshot.
Can I
Go
jump
ahead.
in there for just I want to make sure that we're really clear. Can you start this at the beginning, like at lease up time? Can you get them on this?
Yes. In fact, I probably should have included a slide for that, but Julie, I'm glad that you asked. So the way that this works in terms of implementation, right? Generally, we tell people that if you were to call me or someone from our team and say, Jason, RiskRelease makes perfect sense. I'd like to get this going. I'd like to implement it at my community. What we typically do, right, is we need to make sure that we can integrate with the software provider that you're working with. But once we do that, it's just a matter of taking our lease addendum amendment language and inserting it into the lease form going forward. And then any new residents coming in or any renewal residents that are going to basically re-sign their lease, they're now going to have that addendum that says you are required to purchase $100,000 of renter's legal liability. And if you elect not to purchase it or you allow your coverage to lapse, you will opt into the RiskRelease program at $15 a month. So they still have the choice to do that. And then it's kind of their own prerogative of whether they want to go source their own policy or whether they want to take advantage of the RiskRelease solution. But basically, Julie, to answer your question, after 12 months, every single resident in the community will now have that addendum, and they'll all be eligible to participate in the program. And our compliance service agreement reads such that if there happens to be a resident who does not have insurance, but they do have the addendum, and we were not collecting the $15 monthly fee, we will still honor the commitment to protect the unit and pay for the claim, because that's kind of on us and our compliance guarantee that everybody is going to have coverage by being part of the program. That makes sense.
Okay. So there is no, at the beginning of the start of the lease, they could get on it at what, $4 or $5 a month.
Right. They would, yeah, they would, it would be probably $15 a month. But basically what that works out to, right, do the math, is about $180 in premium a year. And in doing so, they don't have to go fill out an application. They don't have to send a check in the mail. They don't have to create a username and password and start making credit card payments. It's just basically part of their rent, right? And one of the things that we'll be doing in the next 60 days here is we're going to create an additional offering where going to riskrelease.com will not only allow you to upload your insurance, but you can actually click a link and buy your own policy. And again, it will be a very simple, what's your name, what community do you live at, what's your unit number, and what limits do you want? And they can basically buy their own policy that way if they don't want to just roll into the risk release program. So the goal here is, use technology, make it your friend, integrate with the software that's already being used, and then we'll collect all the paperwork. And so that's kind of what I've done here, is just grabbed a screenshot. And so along the left side here, you can see that, you've got 1, 2, 3, 4, 5 different documents that are being checked in. This is a policy from Farm Bureau Insurance. We tie it back to a resident that's at a particular community. We make sure that they have, what their required limits are. And then basically this will determine whether this is a resident that's going to be in the risk release program, or whether it's a resident that's buying the third-party insurance. And so we do this each and every day as the mail kind of comes in. And so just kind of showing you a snapshot. And actually what we'll do is we'll provide your community managers, or we can provide the ownership team with a login and password so that they can go in and they can see what's the participation rate at each of my various communities, which residents are basically providing compliant insurance versus in the risk release solution. And so it just, kind of giving them another tool for the toolbox, if you will.
So from a cost savings, it's an overall cost savings on your insurance policy, correct?
It can be a cost savings in the sense that by implementing a program like risk release and allowing risk release to pay for those resident negligence claims so that you are not filing a claim on your actual building insurance policy, you're now reducing the loss ratio, which is the most important metric that an underwriter uses to determine what kind of rates you're going to pay year after year. They're basically going to say, like, what's your historic losses, right?
Right.
And so if you get hit with a hailstorm, your community, along with every other community in your zip code, probably got whacked. But if you have residents that, are basically habitually starting your units on fire or flooding them out, like, they're going to say this is a building that has looks and feels and performs like a bad risk. And so I'm not advocating saying that risk release wants to be paying claims each and every day or every other day, right? We want to have good performing buildings just like everybody else. But at the end of the day, the actuarial analysis suggests that if we're charging $15 a unit or $16 a unit, and risk release is holding on to $10 of that 15 every month, providing the revenue share, we can scale and support enough units that we're going to collect a little bit more than we're going to pay out. Obviously, everybody needs to be in business to stay in business, but that's the way the economics work. And so this is really just kind of a high level showing if you have 1,000 units, right, between a couple different buildings, the revenue to the community with 75% participation is going to be about $12,000 a month. And then with the revenue share to the owner, that works out to about $4,000 a month. But really, it's this bottom part of the table that really gets people's gears turning, right? So when you think about this on an annualized basis, now you're increasing the NOI at the property, right? So if you're increasing the NOI and you apply a cap rate multiple to this, it's actually enhancing what you're able to achieve on exit. And if you want to get really creative, some folks have said, well, when we go into, marketing an asset for sale, a lot of your buyers are going to look at your NOI or your revenue, your rent figures, and then they're going to underwrite their own expenses. So if they're looking at the revenue figure just being the $15 a unit or $16 a unit as additional revenue, and they underwrite their own expenses, one could potentially argue that instead of creating $900,000 of value, you're actually creating closer to $3 million of value on the cap rate multiplier on exit. So I'm not sure if everybody's following or if that makes sense, or Julie, if I should be explaining it differently, but are you kind of following what I'm saying?
I need some help with that.
Okay. So when you have, when you sell a property at a cap rate, right? You're applying that 5% cap rate against your rents over your expenses. Mm-hmm. So naturally, if you can increase the number that's representing your rents, and the revenue share coming in from risk release is growing your rents through virtue of the revenue share, that multiplier with the cap rate is going to gross up what your argued exit price might be or what your sale price might be, right?
Got it. Yes.
So if you have higher rents, you're going to have a higher sale price.
Mhm.
So if you were to categorize the $15 a month per unit as additional rent rather than the $5, right? So you're kind of representing the full 15. It would even further elevate the exit or the optics of the performance of the asset relative to others in the market, right?
Gotcha.
Because a lot of times
Yes.
you look at rent per square foot. So it's getting a little bit nuanced, but for the people that really kind of get into the nuts and bolts of it, it's just another way of showing the accretive value that's created through the program. So I've got another slide here that is very similar but slightly different, and I just want to also.
Jason, I have a question, so I'm going to interrupt you now.
Yeah, perfect.
I'm a
Thank
little
you.
bit confused at what you just explained. So because you're charging $15 more to the tenant, so my NOI will go up potentially because I have more income. So it's not considered that $15 that they're paying it is to the owner or to you, or how is that considered part of
Right.
the rent, and so the income it's higher, and then in NOI at exit also higher.
Right. So let's just use a single unit as an example, right?
Mhm.
So if we're going back to this slide here, and we've got a single unit, and that resident is paying $1,000 a month in rent, right?
Mhm.
So if the risk release program is rolled out, and that resident is going to participate in the risk release program because they haven't bought their own policy, they're going to now pay $1,015 a month. So they're going to pay their $1,000 base rent, and then they're going to pay $15 as the risk release waiver program charge.
Other income.
Right. So other income of $15. Now, what risk release does behind the scenes is we'll bill the community $10 a month for that single resident. So the community is able to capture an extra $5 net as a revenue share for each resident that participates in the program.
Mm-hmm.
So now when you go to sell that property 2, 3, 5 years down the road, and you've got 70% participation into that program, you're multiplying that $15 of additional rent or additional income times 70% of your units, depending on how many units are in your community, and it represents a much larger number. So when they look at the trailing 12 financials or performance of the asset, they might see that $15 line item for those various residents that are paying it, but they may not see the $10 per unit that's being charged to the community on the back end, right? So it all kind of comes down to how astute your purchaser or your, whoever it is that's doing their own due diligence on the buy. But irrespective, they're either going to see $5 of additional income, or they're going to see $15 of additional income. And this is why people do things like valley trash, right? So you're not going to take your garbage to the dumpster by yourself. We're going to bring in a service for $15 a month, and you're going to put your trash on your doorstep, and somebody's going to come collect it and put it in the dumpster, right? So now you got an additional $15 because you got valley trash, and valley trash might only invoice you for $10 a month as a community and allow you to keep $5.
Mhm.
And so these are all the different ways that you can create additional kind of passive income by virtue of owning and managing these communities. So Heidi, does that help you?
So it is seeing that $10 went to community to valley trash, and then $5 it's income
Correct.
to make it look like I have higher, like they're paying higher rent.
That's the way a lot of those programs work, yes.
Okay. Thank you.
You're
Hey,
welcome.
Jason, I have a question.
Yep.
Is the $10 a month in your example automatically withdrawn regardless if that tenant paid the 15?
So we do, yeah. So we do charge $10 a month for all of the residents who are being billed 15. So you do have a little bit of a spread if you have some residents that fall behind on their rent payments. But the thought process goes, right, is as long as you have, you know, the majority of them paying rent, you're still going to come out net positive, even if you have, you know, 3 or 4 residents that are behind on their rent payments.
Right. Okay.
And you're
And
going to
then
cover
obviously-
them.
Yeah, and then we're going to cover them. But good question, Orlando. So this is the other way that we've rolled this out, and I would say probably around 15% of the communities that we work with have done it this way. We're doing this in Arizona, we're doing this in Nevada, we're actually doing this in Dallas with some owners, but they're basically saying, you know what, rather than you do the compliance and collect the certificates and everything else, we're saying, we just want to put this addendum in that says there's going to be a risk management fee. It's going to be added to our lease agreement, and everybody's going to have this coverage because I don't want to deal with State Farm. I don't want to deal with Lemonade. I don't want to deal with adjusters. I just want to know that RiskRelease is there so that if we have a situation, we can send it to you guys, let you take care of it. And so the way that we've structured that is we've said, you know, we don't necessarily need to charge $15 because we're going to capture a wider audience. And, you know, normally the more, I would say, responsible, diligent, astute residents, those are the ones that are going to go out and buy their own policy anyway. So they're less likely to, you know, they're going to take better care of their units. But in these situations, what we've done is we've said, we'll charge the residents $12 instead of $15. We'll provide a revenue share of $4 a unit for every single unit in the portfolio. And now you've got 100% participation. And, you know, it's just a different way. You know, some people say, well, I don't want to force something on my residents. I want to let them have the choice. But other people might say, I don't trust any of my residents. I just want to put this on everything. And so we kind of leave that out there as kind of an all-in option. I like to play poker, so I call it the all-in option. Everybody's in. So that's really the detail there. So, you know, what does it mean for the residents? 100% of the occupied units will be protected because either they're going to have their own policy or they're going to be in the RiskRelease program. The residents have the peace of mind of knowing that they're covered and they're not going to have a deductible should there be a loss. So that's certainly something that's kind of nice. And one of the things that we do, because there are a couple of other players in the space that offer this, is if we have a resident who, let's say, we get a notice in the mail that says on January 5th, their policy is going to cancel for non-payment of premium. So we put them in the RiskRelease program as of January 6th. Then on January 20th, we get another piece of mail that says, hey, this resident actually paid their premium. We've now reinstated their coverage retroactive going back to January 5th. What we will do is we will issue a credit going back as far as 30 days so that that resident actually, their net impact or out-of-pocket expense is 0, because we all get it. You know, sometimes you forget to pay a bill, or, you know, maybe you fall behind or you're late. We don't want this to be like a thorn in the side of a resident. We just want this to be something that provides the added protection. But if you have a policy and it cancels and it reinstates, or if you get charged $15, let's say, and you say, you know what, I really don't want to do the RiskRelease program, I want to go get my own policy. 15 days later, they say, hey, look, RiskRelease, here's my policy. We'll give them a credit for $7.50 because they were actually only in the program for half the month. And so we just, you know, kind of want to keep it basically all what it would be reasonable and appropriate for the residents. Some of the other programs that are out there, they're like, we're just going to charge them every month. If you want to give them a credit, you can do it on your own. And that's just not the way that we want to set up our program.
Jason?
So, yep.
I got 2 questions. One is the coverage that you mentioned, the 100,000, kind of the baseline, and that's kind of what you write all the policies are, or that change? And then the second question is, have you ever had anybody where they just charge that, let's say if it's $15 a month, do they charge it all up front as a, kind of like a security deposit first month and $180 for your first year of, for this thing?
Yeah, we haven't done it that way. We've always just kind of done it as a month to month. I mean, I suppose that you could, but I think that most of the residents, that are kind of in that workforce housing or kind of apartment space, they're more prone to be attracted to spreading out the payments as opposed to paying them in one lump sum. So this is just kind of an overview of the onboarding process. Obviously, we want to gather the details. We have a compliance service agreement. Then depending on whether you're using Yardi, Entrada, Resman, Rent Manager, there's a couple of different like API keys and URLs that we're going to need to collect that basically allow the two systems to talk to each other. And then we give you a copy of the addendum. Most of our owners and managers use Blue Moon for their lease forms. But even if you don't, it's something that you can easily incorporate into whatever paper, electronic version of the lease that you use. And then we'll provide a training to, whoever your community management team is, so they know how to answer questions of the residents if they come to them with questions, or so that they know how to direct the residents to upload their documents onto RiskRelease.com. And then we'll give you a bunch of, kind of collateral or onboarding materials, a virtual brochure, just like some one-page overviews, things like that. But we just want to make sure that the team is well equipped to kind of speak to the program and understand it. But then basically the residents will go to RiskRelease.com. They'll upload their information. We will provide compliance feedback because the residents provide us their email when they upload their information. And we have the ability to also copy in the community managers on that correspondence if they want to be privy to kind of any sort of back and forth with the residents, right? Because RiskRelease is a B2B product, right? We're selling this to the owners and to the managers. We're not necessarily selling it to the actual individual residents, but obviously the residents are benefiting and they're the ones that are, participating in the program. So that's kind of how that works. I don't know if anybody has any other questions, but that's really kind of the high level in a nutshell. Again, appreciate the opportunity.
Jason,
Sure.
I've got a question for you.
Hold on, Ashley, just a minute.
Okay, sure.
The question what came up, Jason, about is it all 100,000 coverage on every policy? I just didn't get clarity on that.
Yeah, so what they might be asking is like, can you provide a program with 150,000 or can you provide a program with 200,000, right? Because as insurance companies push their owners to higher and higher deductibles, that's kind of one of the questions that we're getting. And we have entertained, providing 150,000 or 200,000 in limits. It's obviously going to be a few dollars more expensive to do that, but we're willing to kind of have those conversations with different, clients as the requests come up.
Gotcha. Okay, thank you. Ashley.
Oh yeah, so I've got a real life case study that from my perspective is almost nauseating to me, but I've got a 32 unit property, second floor unit in an 8-unit building. The tenant, so I get a call the other day from the property manager, which is never a good sign. And so they tell me that there was a water leak because the tenant had installed a bidet on the toilet, and then it exploded. It just, it didn't do it right, exploded, flooded the whole unit, and damaged the 2 units below.
Right.
The tenant, acknowledged that he is responsible, that he did it, and he knows he caused it. And then, so my first question was, tell me about their tenant insurance policy. And they say, oh, well, it expired like last week. So what would happen if I had RiskRelease? How would my life be different and happier now than it is?
Great question.
So Ashley, this is the exact scenario that RiskRelease was created for, because we would receive documentation. There's a good chance that residence policy didn't expire last week, probably expired a long time ago. But the moment that we became aware that that resident did not have insurance, they would start paying $15 a month as additional rent, and they would have up to $100,000 in coverage. And so we get the incident report. Ashley says, hey, the guy, he or she installed the bidet. They didn't do it right. They weren't around. The thing decided to, start doing its job even when it didn't need to, and it never stopped. And so we would say, go get your contractor. What kind of flooring or drywall or trim needs to be replaced? What's it going to cost to prime and paint it? Give us 2 bids, pick the least expensive of the 2, go out and get it done. And as long as it's less than $100,000 worth of damage, we're going to cover the whole cost and write a check to the community.
Okay. And in addition to that, I would collect 5 of the $15 that the tenant was now paying would come to me.
That's right.
And then, so tomorrow, my meeting with the property manager to ask them for an audit of all of the tenant insurance policies. I can just hear their eyes rolling already because they don't want to do this.
Right.
And then my next step is going to say, well, all these guys that are expiring next month, I want you to call them and make sure their policy's in order. Then they don't have to do that anymore if I have risk release, right?
Right, because they're going to basically see the $15 on their ledger because their lease says that we're allowed to charge them $15, right? Now, of course, you got to get them to roll on as their leases renew. But once they have that, the decision is theirs, right? They can go buy a policy from, Uncle Joe with State Farm or, their friend Susie from college that has an Allstate agency or USAA, or they can just say, screw it, I'm just going to pay the $15 because it's easy and I'm good.
Right. Okay.
Great example. Thank you, Ashley. Unfortunate that you had that loss.
I'm happy
Sorry to
and
hear
sad
that.
to be able to provide the case study.
Yeah. Thank you so much. I appreciate that.
I had a claim this week because a resident decided to use a barbecue grill in their kitchen.
Oh,
Nice.
One of those small outdoor grills.
unbelievable.
Crazy. Well, this has been amazing. I some of these things, that's what's great about Zoom at 8. I'm bringing, speakers. I'm bringing items, products that maybe none of us have thought about, right? And how to increase your NOI. And this is an area that you might have not thought about. So Jason, when do we get a hold of you? When do we underwrite this into the deal? Is it before we take over and to get this in the plan? When does this happen?
Yeah, you can do it at any time you want.
Okay.
We're happy to be involved, from day one. And so, once you guys take ownership and you close on the asset, you can introduce us to the property managers and basically put, the lease form together with the addendum. And then basically anybody and everybody's going to be kind of incorporated in part of the program from day one. But it could be, Ashley says, oh my God, I can't believe that this happened. I'm going to have my community managers, tell me what the number is of how many policies they actually have. And then I'm going to say, you guys are doing a terrible job. I found a solution. We're going to roll this out. And then it's just a matter of, like I said, kind of collecting the details, putting the training call together, giving you a copy of the addendum. And so one of the things, that, because naturally, right, if I'm trying to grow the business, I'm going to be looking to source owners that have 1,000+ units, under their belt or under their, kind of under management. And if you're Ashley, maybe you got one building and it's 32 units, right? That is not necessarily the type of client that's probably going to use Yardi, because Yardi is way too expensive to buy the license for 32 units. And so maybe you're not using Resman, and maybe you're not using Entrada, and maybe you're not using Rent Manager. But in those situations, that's where you might want to think about, like, do we just put this on all of them? And now maybe we say, we still recommend that you go buy a policy, but this is something that the landlord's doing to protect their operating expenses, which ultimately are going to push rents higher if it means that our insurance costs are going to go up without this, right? And so that's one of the things that I tell people, if they don't work with a property management software where we're already integrated to do kind of the checks and balances of, because we literally get a real-time feed every day of all the residents, all the unit numbers. Somebody moves out early, somebody moves in early, all that stuff. It's all a real-time feed.
Awesome. All right. Any questions before we move on to networking? All right. Speak now or forever hold your peace, as they say. All right. Well, all right. For those of you who are listening on
Question.
YouTube. Oh, yes.
Make sure I
Angel.
heard it right. I couldn't get off mute. The addendum is so you do not have to wait for the release, right?
No, the addendum allows us to be able to charge them $15, right? Because you can't just like take a resident who signed a lease 6 months ago and say, hey, we're going to charge you another $15 of additional rent.
Okay.
Awesome.
I got
All right.
excited there for a second. Sorry.
Oh, yeah. All right. So for those of you on YouTube who are listening to this and can't read the chat, www.riskrelease.com, and to reach out to Jason or write your company 312-391-8431. So
That's my personal cell. So
well, you know what? We are reaching out for questions, not what Jason's cat's name is, right? Yes,
That's right.
that's correct. All right, excellent. Well, Jason, hey, great to have you on tonight's Zoom at 8. It's been wonderful. I hope that, you benefit from tonight. You're always welcome here at Zoom at 8 and always able to pop in and introduce yourself at the beginning of Zoom at 8, like many of our other vendors who show up here. So